I think that now we're in much worse shape. The economy is far worse than it was in 2016. That's why he won by a wider margin. And the reason he won the first time, and the reason I predicted he was going to win the first time, and I predicted again, is that I knew the economy was much worse than the media was portraying, and the Federal Reserve and Wall Street. And the same thing is true now. We have a horrible economy beneath the surface. And Trump just showing up is not going to fix these problems. And neither will simply cutting taxes the way he has advocated, because most of the taxes are not really growth oriented. They're consumption oriented. You're cutting taxes on overtime, on tips, on Social Security benefits. So all this money is just going to be spent.
Why doesn't the market like gold on the back of a Trump victory?
Well, because again, everything is risk on, right? Gold is risk off. So people think the U.S. economy is going to boom. The stock market's going to boom. Why do I want to own a safe haven like gold when I can make a fortune in the stock market in this booming economy? They also think that the strong economy is going to mitigate the rate cuts, so we won't get as many rate cuts as the market might have thought. So they think that higher interest rates is a negative for gold. Yeah. Also supporting the dollar. We've had a big rally in the dollar since Trump won, and so that is weighing heavily on gold. Also, we've had some comments, and speculation that the BRIC nations and other nations that were moving away from the dollar are now going to embrace it because they don't want to piss off Trump because he's threatening all these tariffs. And so maybe because now we got, a new sheriff in town, that the move out of the dollar is going to slow, and that the central bank buying of gold, because if central banks try to be more friendly to the dollar to appease Trump, and hey, we're not selling our dollars, right? Don't tariff us. Look, we're your buddies. If they're going to stop that, if they're going to stop selling their gold, their dollars, they don't have to buy as much gold. So there's a lot of reasons that people are thinking, hey, this is going to be bad for gold. Now, look, gold went up by about 40% during Trump's first term, about 10% a year. And so it wasn't like, gold didn't do well when Trump was president. But I think it's actually going to do a lot better, despite what the markets are saying right now. I think the markets are wrong again on this. I think a Trump presidency is very inflationary, but that's not bad for gold, because the Fed is not going to fight the inflation. In fact, if it tries, the Trump administration is going to beat up the Fed pretty bad, and then put a lackey in there when Powell's term is over, if Powell doesn't cooperate, because Trump wants low interest rates. If you remember, when he was president the first time, he was very critical of Powell for raising rates. He demanded lower rates. He wanted rate cuts. He wanted negative interest rates. He was upset that Europe had negative interest rates and we didn't. He wanted more quantitative easing. And the only way to finance these tax cuts without skyrocketing long-term interest rates is to go back to quantitative easing. So I think that this is going to be an inflationary, 4 years. And I think the short-term impact of the tariffs, of kicking out the illegal immigrants, and the tax cuts is going to accelerate an inflation that was already on the rise. So I think the dollar's rise is going to be short-lived, just like gold's decline. Now, by short-lived, could it go on for weeks? Could it go on for months? Sure. I don't know. I don't have a crystal ball as to when the markets are going to turn.
When discussing gold and its market dynamics under a Trump presidency, Peter Schiff dives into the perplexing contradiction between market sentiment and historical performance. Despite gold appreciating roughly 40% during Trump's first term, an impressive 10% per year, the market sentiment often painted a different story, leaning heavily on risk-on assets like equities. This disconnect, Schiff argues, highlights the short-term focus of markets versus the long-term stability and inflation hedging nature of gold. The market's initial reaction to Trump's potential second term reflects optimism in risk-on assets, driven by assumptions of an economic boom, a strong dollar, and limited Federal Reserve rate cuts. The narrative suggests that gold, a risk-off asset, becomes less appealing when stock markets surge and economic growth appears robust. In addition, speculation about the BRICS nations slowing their move away from the dollar to avoid provoking Trump's tariffs feeds into this sentiment. If central banks reduce their dollar divestment strategies, gold purchases might also slow, further dampening demand. However, Schiff counters that these views misunderstand the deeper, long-term implications of Trump's policies and the systemic issues in the global economy. To understand gold's true value proposition, Schiff directs attention to historical context. Gold thrives during periods of economic instability, rising inflation, and fiat currency devaluation, all of which were prominent during Trump's first term. Despite market skepticism, Trump's policies inadvertently fueled inflation. His vocal advocacy for low interest rates, negative rates, and aggressive quantitative easing highlighted the administration's commitment to cheap money policies. These policies, while providing short-term economic sugar highs, sowed the seeds for higher inflation and ultimately a more favorable environment for gold. Take the Federal Reserve as an example. During Trump's first term, his vocal criticism of then-Fed Chair Jerome Powell for raising interest rates showcased his preference for monetary easing. Trump's consistent calls for negative interest rates and greater quantitative easing underline his desire to keep borrowing costs low. While such policies may stimulate short-term economic growth, they also exacerbate long-term inflation risks, a reality that significantly benefits gold as a store of value. Moreover, Trump's tax cuts and spending policies widened fiscal deficits significantly. In his first 3 years before COVID-19 even entered the picture, government spending grew by 4 cents on every dollar, despite his campaign promises of fiscal conservatism. When COVID struck, deficits exploded, further validating Schiff's claims about unsustainable fiscal policy. The same dynamics apply if Trump were to return to office. His promised tax cuts and immigration crackdowns would fuel inflation, increase costs for American businesses, and drive the demand for inflation hedging assets like gold. A Trump victory also places the US dollar in a precarious position. While markets initially cheer a stronger dollar as a short-term win, Schiff warns that this strength is unlikely to last. The dollar's rise is driven by sentiment rather than fundamentals, and the structural challenges facing the US economy, ranging from trade deficits to soaring national debt, remain unaddressed. Trump's proposed policies would likely exacerbate these imbalances, creating long-term headwinds for the dollar and tailwinds for gold. Trump's trade policies further complicate the economic landscape. While tariffs may make imports more expensive, they do not address America's reliance on foreign goods. Instead, higher costs are passed on to consumers, feeding inflationary pressures. Simultaneously, the tax cuts Trump proposes would fuel consumer spending, driving up demand for imports. The result? Wider trade deficits and rising inflation, an ideal scenario for gold to shine. One of Schiff's most compelling points revolves around market psychology. Many investors view gold as a hedge against short-term uncertainty rather than a long-term store of value. This perspective leads to irrational sell-offs during periods of optimism, such as the initial market reaction to a Trump victory. However, as Schiff argues, gold's value lies in its ability to preserve wealth over decades, not just months. For Schiff, the takeaway is clear. Gold's appeal transcends market sentiment and political cycles. It is a time-tested hedge against inflation, currency devaluation, and economic instability. Whether Trump wins or loses, the structural challenges facing the U.S. economy, ballooning deficits, rising debt, and unsustainable monetary policies, will persist. These challenges, coupled with an inflationary environment, create a robust case for gold as an essential component of any investment portfolio.
You know, we've been kicking the can down the road for a couple of decades now, going from bubble to bubble. And that includes when Trump was president the first time. You know, I remember when I voted for Trump. I was hoping that maybe he would actually be able to cut government, and that, the fact that he wasn't a politician, he would not behave like one. I was wrong on that. But he ran on a platform of cutting government, reducing government spending. He had something called his penny plan. He was going to cut, every year he was president, he was going to cut spending by a penny, 1 penny out of every dollar, which wasn't even enough. But of course, he didn't do that. He ended up increasing spending by 4 cents on the dollar for the first 3 years. That's, not counting COVID. If you count COVID, it was something like 16 cents a year because spending blew up so much in 2020. But even before we got to COVID, Government spending was going up under Trump. The deficits he talked about paying off the national debt as a candidate. He ran up a lot of debt. The debt went up 50%. The budget deficits went up 50% in his first 3 years before they, went through the roof during COVID. So he did end up setting the record, which Biden just broke, for the most amount of debt added in one presidential term. So he expanded government. In fact, even when the Republicans had both houses of Congress, they increased welfare spending in addition to warfare spending. He added a department. He added the Space Force. I mean, he didn't eliminate a single agency or department. And so I think that now we're in much worse shape. The economy is far worse than it was in 2016. That's why he won by a wider margin. And the reason he won the first time, and the reason I predicted he was going to win the first time, and I predicted again, is that I knew the economy was much worse than the media was portraying, and the Federal Reserve and Wall Street. And the same thing is true now. We have a horrible economy beneath the surface. And Trump just showing up is not going to fix these problems. And neither will simply cutting taxes the way he has advocated, because most of the taxes are not really growth oriented. They're consumption oriented. You're cutting taxes on overtime, on tips, on Social Security benefits. So all this money is just going to be spent. And since we already have record trade deficits, the trade deficit we had last month, merchandise trade deficit, was the worst in history, with the exception of 1 month right after we did the COVID reopening. But we've never been more dependent on imports than we are right now. And if we just give people a bunch of taxes, they're going to spend more money on imports. Now, yes, the imports will get more expensive because Trump is going to put tariffs on those imports. Yeah. But we're still going to import them because we don't have the ability to produce the stuff ourselves. We're just going to have to import more and pay higher prices with the tariffs. But the other problem is the tax cuts are going to blow a big hole in it already, more than $2 trillion a year deficit. When Trump came to office in 2016, the annual deficit spending was about $650 billion officially. And when Trump came to office the first time, the Fed funds rate was 0.5%. Now it's 4.5%. And the yield on the 10-year was 2.5. Now it's getting close to 4.5. But rates are moving up a lot higher, so we're going to have much higher interest rates with much bigger debt. And Trump is talking about mass deportations, which I'm all for having a strict border. Most of the jobs created under Biden were for illegals. That's kind of where they came from. And so if we kick them out, who's going to do that work? And what are we going to have to pay Americans to come off of welfare and take those jobs? Yeah, sure. There are some people who are on welfare that will kick out, and there's some criminals, and that'll be good. But I think overall, we're going to actually do more harm because we're going to deplete our labor supply, and that's going to further drive up the cost of production in the United States.
One of Schiff's key points is the ballooning U.S. national debt, now over $33 trillion and climbing. A second Trump term would likely exacerbate this issue, as his proposed policies, tax cuts, increased defense spending, and infrastructure investments would significantly expand the fiscal deficit. Schiff points out that servicing this debt at higher interest rates will be a Herculean task, requiring even more borrowing and ultimately money printing. This creates a vicious cycle where the dollar's purchasing power erodes, making gold's role as a store of value more critical than ever. Schiff describes gold as a financial lifeboat, a safe haven asset that becomes indispensable when the economic ship starts sinking. Historically, Schiff reminds us, gold has proven its worth in similar scenarios. In the 1970s, the dollar lost 75% of its purchasing power, and gold skyrocketed from $35 to $850, an astronomical 24-fold increase. More recently, during the 2000s, gold rose from $253 to $1,700 as the dollar faced internal challenges. Schiff uses these examples to highlight gold's ability to retain and even grow its value during periods of economic turbulence. These historical trends are not mere coincidences. They are a reflection of gold's fundamental role as a hedge against currency devaluation and systemic risk. Schiff's analysis also extends to the geopolitical landscape. The global move away from the US dollar as the world's reserve currency is accelerating, with central banks around the world increasing their gold reserves. Schiff argues that this trend is driven by a lack of trust in the dollar-dominated financial system. While markets speculate that Trump's tough stance on trade and tariffs might slow this trend, Schiff contends that the underlying distrust in the dollar will only grow. Countries like China and Russia are already leading the charge, seeking to de-dollarize their economies and reduce their dependence on U.S. financial systems. Gold, as a universally accepted and non-politicized asset, becomes the natural choice for these nations. Another dimension of Schiff's argument is the impact of immigration policy on the U.S. economy. Trump's proposed mass deportations, while politically appealing to his base, could have severe economic consequences. Undocumented workers fill critical roles in industries like agriculture, construction, and hospitality. Removing these workers would strain an already tight labor market, driving up wages and production costs. While this might sound like a win for American workers, it would also exacerbate inflation, a development that Schiff sees as bullish for gold. Higher costs for businesses and consumers would reduce purchasing power, making gold an even more attractive hedge against inflation. Schiff also critiques Trump's trade policies, particularly his reliance on tariffs. While tariffs aim to protect domestic industries, they often end up being a tax on consumers. America's dependence on imports means that tariffs merely increase the cost of goods without addressing the root causes of trade imbalances. Schiff warns that tax cuts, coupled with increased consumer spending, would worsen these imbalances, driving up inflation and further weakening the dollar. In this scenario, gold would not just be a safe haven, it would be a necessity for preserving wealth. Turning to the broader investment landscape, Schiff highlights the disconnect between market optimism and economic reality. The stock market's current buoyancy, fueled by speculative exuberance, belies the underlying weaknesses in the economy. Schiff draws parallels to previous bubbles, such as the tech bubble of the late 1990s and the housing bubble of the 2000s, both of which ended in financial crises. In such environments, gold and silver emerge as reliable alternatives to overvalued stocks and bonds. Silver, in particular, holds a unique position in Schiff's analysis. While often overshadowed by gold, silver's dual role as a monetary and industrial metal gives it additional layers of demand. The rise of renewable energy technologies, such as solar panels, is driving a surge in silver consumption. China, for instance, has been aggressively acquiring silver resources in Central America, paying premium prices for raw silver ore to fuel its green energy initiatives. Schiff argues that this industrial demand, combined with silver's historical role as a monetary asset, makes it a compelling investment. During previous bull markets, silver has often outperformed gold in percentage terms, and Schiff sees no reason why this trend won't continue. Schiff also addresses the psychology of investing in precious metals. Many investors view gold and silver as speculative assets, hoping to capitalize on short-term price movements. However, Schiff emphasizes that precious metals should be seen as long-term insurance policies against systemic risks. The goal is not to time the market perfectly, but to secure financial stability in an increasingly unstable world. Schiff warns against waiting for the perfect moment to buy, as market conditions can change rapidly. By the time the masses realize the importance of owning gold, it will be too late, he cautions. Central banks' recent gold-buying spree underscores Schiff's point. These institutions are some of the most informed participants in the financial system, and their actions speak volumes about the state of the global economy. Schiff sees their accumulation of gold as a clear signal that the dollar's dominance is waning. For individual investors, this trend is a wake-up call to follow the lead of central banks and secure their own holdings of precious metals. Schiff also challenges the perception that higher interest rates are inherently bad for gold. While rising rates can increase the opportunity cost of holding gold, Schiff argues that the broader context matters. In today's environment, where real interest rates remain negative when adjusted for inflation, gold's appeal remains strong. Negative real yields erode the purchasing power of cash and bonds, making gold an attractive alternative. Schiff describes this as a silent tax on savers, one that gold can help mitigate. In conclusion, Schiff's analysis paints a compelling picture of gold and silver as essential assets in today's economic and geopolitical landscape. Whether the trigger is inflation, currency devaluation, or geopolitical shifts, the case for precious metals is stronger than ever. For investors, the message is clear. Gold and silver are not just investments. They are lifelines in a sea of economic uncertainty. As Schiff aptly puts it, gold is the only real money. Everything else is just credit.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.